Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, we're going to talk about the EIA, and we're going to try to bring you the most up-to-date energy content possible. So here, we're going to discuss in terms of what's happening across the EIA, looking at the overview, refined products, and then really digging into some of those exports. So here, we're just going to jump right in and really kind of discuss what's happening on the crude stocks level. So here you can see we had a total draw, but we have to look at the SPR because some of those additional barrels that were stored in the Strategic Petroleum Reserve are starting to come out. So the draw was actually 4.3 million and not the headline 1.63 million. So this is something that's going to continue over the next couple of weeks as we see some of this start to normalize. But the draw was really driven mostly by Pad 3 as we had a little bit of an adjustment in terms of imports coming in, starting to fall off. And then we'll talk about a little bit in terms of what's happening on the refining side. Production, again, this is more of a monthly update, so we won't see this really adjust until September. Again, we have something closer to about 11.2, but as you know, going back to our Friday discussion when we talked about the Frac Spread Count, we think that we're going to get a pickup in activity as we go through the remainder of August into September, and then those barrels will start to appear, which is going to kind of help bridge some of that gap as we go through, which is going to push us to about 11.3, 11.5 million barrels a day. The problem is it's going to hit the market at the exact wrong time when we consider the seasonality aspect of refining. So here, just going back and looking at total inventories, you can see that we're still near all-time highs, but again, the trend is moving in our favor. We're starting to see some of those draws, which we normally see as we get into Labor Day. The question is going to be, how does this look as we get into the remainder of the year, given the fact that we've seen an increase in crude oil on the water? We're starting to see stickiness in terms of storage in Asia as well as other areas. So this is going to be a wait as we consider drawdowns. But again, this is something that is at least relatively positive for the US starting to kind of normalize. And that's when we turn to Pad 3, because Pad 3, we're still at seasonally adjusted and even going back all-time highs. The problem is going to be as you get a restart of the Permian and some of these other areas, how is that flow going to adjust? Because we're expecting a ramp down, just given the announcements that we've heard from refiners. We're going to have refinery utilization dropping really along the seasonal norms, but again, at a different level. But again, moving, following the normal trend line, which is going to put pressure on storage, because we did see some purchases. They haven't come into our Gulf of Mexico yet. But again, you're going to see an increase in U.S. production, some stickiness in terms of the imports at the same time when we're seeing refinery utilizations start to fall for normal fall turnaround, which is going to be a problem as we go and look at, okay, well, what's happening in the current import crude runs? So imports were up slightly by 110,000 barrels a day. It was really driven by Pad 1, where Pad 1 had the largest increase since November. Pad 3 was kind of that small increase, but again, those are things that are going to ebb and flow. As we look to Pad 3 going back to the 5-year average, you can see obviously we're still pretty far off, and it just comes down to those refinery utilization rates. But we're starting to see some movements in VLCCs, but we're seeing some stickiness in terms of tanker rates on products, because the products remains a problem on a global level when we look at storage, which is something that we're going to talk about in our OPEC Plus update coming out on Friday. So here you can see runs started to slow down a touch, just came off about 10 basis points. But this is a trend that we're going to continue to see as we had a recent fire that impacted some of the flows. But at the same time, we have those turnaround announcements, which is going to start to weigh on us, as we're already at only about 80.9%, which means that as these run cuts start to come through, we're going to get back down to the low 70s, upper 60s. And we really think that's going to be driven mostly by Pad 3, because we've already had those official announcements coming out of the West Coast, which is going to impact gasoline in the near term. Implied demand took a big step down. This is something that we've been talking about, where we had a big spike as we backfilled for the storm that hit the East Coast. We had additional storms in the Midwest. And again, like it's just timing delays, but these step downs were relatively large. But again, this is going to be some normalization. It's just not going to normalize above where we've been talking about of averaging about 8.5, 8.6 million barrels a day of gasoline demand, which is going to be sticky, which we'll talk about in the next segment. Distillate, again, this is something where we saw a pullback, but there's going to be some bright spots in terms of distillate, but total product demand was down 2.2 million barrels a day. And when we look at oil floating storage, again, this is also timing. So we're back down to the seasonal lows in terms of the 5-year average, but you have to consider what is deemed floating storage. So it's a ship that's been sitting for 7 days. And there's been a tick up in terms of oil on the water and oil in transit. So we will start to see this move back to the 5-year average as more ships show up and are waiting to offload. And then as we look at imports, again, the imports are obviously going to marry kind of to where that floating storage is. And as we see more pressure appearing on the refinery utilization rate, specifically in the Gulf of Mexico, this is going to be a problem. And especially because, Louisiana has already said that the state has announced that several refiners will also be cutting runs due to low demand and then due to turnarounds. So this is something where imports will remain under pressure. Given this is a little low just for where we are, but again, this is something where we're not going to get back to that 5-year average, but we will probably fall within that the cloud for the most part. And when we look at it, we have to look at, again, the utilization rates. Utilization rates, we've said that we would average about 75% through the summer. Right now, we're at about 80%. So this is something where we're going to kind of maintain this 79, 80 as we go through the remainder of the year. But then as turnarounds start to pick up, and if you look at the 5-year average, you can see it starts to fall, which really picks up at Labor Day and then falls off as we go through the remainder of the September and October, and then they start to reverse in November. So we're going to see the same normal trend. It's just clearly it's going to be at a much reduced level, which is going to be a problem for total oil demand. And the reason why we have confidence in saying that is just looking at the 2020 average of total U.S. product demand. So this is looking at gasoline, jet fuel, distillate, fuel oil, and to understand, okay, well, we've been talking about hitting this plateau, and here we think it's it's clearly defined as to hitting that ceiling and starting to see that roll, which we think is going to roll back over. Because if you look at 2019, 2018, 2017, we have that natural dip as we go into the turnaround season because you just don't have the same demand as people, the vacations are over. But here we're going to have additional pressure as work from home is increasing. Business travel remains low. And then the question is going to be what's happening with school and what's happening with in-person through Zoom, which is something that we're also going to cover in more detail in our economy show. Now we're going to turn to refined products. And we really want to discuss with you the key ones that are really the driver, which is really that distillate and gasoline component. So when we turn to disti, you can see that we actually had a build of about 150,000 barrels, even though there was an expectation of a draw. Now, when you look at the seasonally adjusted, you can see that we remain at all-time highs. And to see these levels, you have to go back to the early 80s. And it's going to be difficult to see how we see these drawdowns. Exports have increased, which we'll talk about in a minute, but refiners are going to struggle to maintain operations through the shoulder season just because storage remains a huge glut. So that's why we continue to think that we're going to get those additional run cuts to try to kind of normalize some of this. There is a light at the end of the tunnel. We are seeing some pickup in some key locations, but again, disti demand is going to be, within that 5-year average as we continue to see these builds grow, and they normally rise as we go through the shoulder season. So when we talk about the supplied, in terms of demand, we talked about it, falling this week. And again, this just comes back to timing and just understanding and having a feel for the market, but we will see an increase. It will come back to a little bit above that 5-year average. And that increase is going to be driven from several different components. So this is a great chart. We get it from the Daily Shot. It is a great aggregator of some really beneficial charts to understanding what's happening on a global level. But this is one that we pulled out. So the Empire manufacturing numbers we're going to talk about in the economy show, but we really want to hone in here on the California inbound. So you can see we have seen an increase in imports, which is going to be a benefit to see additional trucking demand and hopefully start to see some of this intermodal move. We can see the intermodal containers are starting to pick back up. Again, we're not back above last year. I'm sorry, we're not back above what is deemed in terms of that zero, where we're not back to growth, but we're starting to see some normalization as guys are looking to kind of refill that supply chain. Right now, just in terms of the supply chain and looking at things holistically, it's going to be difficult to see a huge amount shift from truck to rail, just because a lot of guys are trying to be picky in terms of how much they're bringing in. Retail sales in terms of traffic and foot traffic remains low, which is going to be a problem in terms of just moving inventory. But again, these are still some bright spots, specifically on the shipping side, which just means we have some imports coming through, moving from the West Coast into the market. And this is something that's going to help kind of pull in and draw down some of that distillate. Looking at rail, we're still looking at it, week over week and looking at it from versus 2019. Rail still fell about 15.6% versus 2019. We're still averaging about 16.2% off of last year. But there are some bright spots. We saw an increase in grain. That's something that will start to increase as we move into the harvest. The problems are going to remain across total car loads. And again, some of these heavy metals, which remain lackluster. And the issue, coming back to those intermodal moves, trucking has been ideal because you can move one or two loads at a time, where when you think about a train, you're pulling 100 to 150 car loads. And if you don't need that kind of size, then that's where we remain to see trucking demand increase. And here you can see we set a new high going back to 2014. We think you're going to continue to see some of this growth, especially as some of those new containers hit the coast and have to be moved into the market. And rates are starting to creep higher. Now, there is a glut in terms of the amount of capacity in the trucking market, but the rates are getting better, not only because of the demand, but also because diesel prices are creeping higher. And typically diesel is a pass-through cost, to the client. So here we're starting to see some normalization. We think that we're starting to peak out, but again, the demand is going to remain robust over the next week or two. So now that we covered distillate, because distillate, is still going to be impacted from industrial production, but again, some of this normalization is coming through. We're still seeing some of this weight in terms of gasoline. So gasoline had a nice draw of 3.32 million barrels a day, which is really driven by PADD 3, which had that draw of 3.56. When you consider, what really happened, imports fell on the U.S. East Coast, or PADD 1, to 2013 lows. So when you consider what last week was, where last week we were pulling in about 380,000 barrels a day, or about 3.2 million barrels, all of a sudden you're like, okay, well, you had the imports fall, again, timing delays. We will get a new increase in imports, not back to last week's numbers, but again, it is going to start to normalize. You also had some hiccups in terms of, obviously, the hurricane pushing through, impacting demand as people rush to fill their tanks. But also when we start to look at the Colonial Pipeline, which had a fire, which shut things down for a short period of time. So here, you're also going to see some of that show up in PADD 3, where you're going to have an increase in storage, and PADD 1, where we will see an increase in draws. So it's just going to be a timing delay as that normalizes, but it's also going to allow some additional imports into PADD 1 over the next 4 weeks, just given how the tracking is looking. But again, even though we've seen a draw and the trend remains along that 5-year norm, we're still at seasonally adjusted all-time highs going back to 1991. And this is something that we expect to see relatively sticky as we talk about some of those issues in terms of drawdowns. Now, when we turn to Gas Buddy data, you can see that we've, Friday into Saturday, we had, things remaining relatively strong. Again, they're not that July 26 high, but it is nice to see some of this stickiness. And as we turn to Sunday into Monday, you're starting to see some of this normalization. The problem is working from home. The vacations are getting that final push into Labor Day. And now we have kids going back to school. So with kids going back to school, and this is something we're going to talk about in the economy show, the question is going to be working from home. How do you manage kids that are now either in person or online or a mixture of both? And this is going to continue to weigh on just total consumption of gasoline as people just don't move around as much and as people just don't feel comfortable, just given where, COVID cases look and what things are going to be going into that fall and winter. Now, here you can see the gasoline demand, just based on the calculated number, was at about 8.6 million barrels a day. Now, this is something where we keep talking about maintaining that 8.5, 8.6. We call that kind of hard bounce off the bottom, and then we figured we were going to plateau right around that 8.5, and here we're kind of waffling between 8.5, 8.6, but we think we're going to get that roll off, which if you look at that 5-year average, you can see that seasonally we have that drop, and that really starts to increase in post Labor Day with the end of driving season, and that's something that we think is going to remain consistent, just again at that reduced level, which is going to hinder total gasoline demand. Jet fuel, there's no need spending too much time. We talked about how fuel demand was going to remain flat and here we are, it's flat. There's not much happening. The question is going to be going forward as we turn to September, October, where you normally see, again, people going back to the office, starting to get into that normalcy. And we just don't think that business travel is going to really react the same way it has in the past, which is going to hurt demand as we go through the fall season. And that's where we turn to those TSA passengers. So you see the drop off. Again, we're within that 550 to 850 level. We're kind of flattening out. But if you look through last year, you can see that there's typically that little roll off as we go into September. And that's something where we think you're going to see the same type of roll off, especially as just corporate travel just never really gets back to those levels that we saw last year. And if anything, it's going to actually move us down back to that 450 to 650 level as we go through the remainder of the year. Jet fuel will remain a huge hurdle. And we're going to talk about that as in our OPEC show after Saudi comes out and says that things are going to normalize in Q4 to 97%, which, just looking at jet fuel alone, you can make up that number. And then once you factor in gasoline and other, it's going to be hard to see that. And that's where we go back to the mobility data. And this is looking at the 7-day moving average, and you can see that not much has changed. And we don't think much is going to change. You had that little blip, but again, it's just, we're going to be here. People aren't really going back to work in terms of working from home. Retail remains well off where we normally see. And it's just, this is going to be kind of the new normal. The difference is going to be those parks are going to start to drop as people have to go back indoors, or at least indoors more, just due to weather changes. But the one little bright spot that we've seen is this open table. Now, we excluded yesterday's data, so this is data through August 17th, because yesterday's data looked a little off in terms of everything being down 94, 95%, even though we know that really isn't the case, just given kind of the backdrop. So we just think that here is kind of, we continue to see that confidence range. That trend continues higher. We're only down about 45% versus pre-COVID. And this is something where, it's again, the trend, people are getting more comfortable, as New York City right now announced that they're in the COVID spread is 0.26%. So again, some more confidence. People feel a little bit better about eating outdoors, maybe starting eating indoors. So this is something that is trending in the right direction. The question is going to be, what does it look like as we break things down? So United States was, again, that down 55%. We saw that big surge in the UK, in Ireland and Germany. The question is going to be the stickiness in Germany, because we've seen an increase in COVID cases. We think Germany's going to kind of slow down a little bit. Merkel has talked about, being very cautious, trying to keep that discipline to keep the COVID from spreading a little bit too much. So here's where something, things are going to normalize a bit. But again, things are getting a little bit better. People feeling a little bit more confident about going out, which is something that we think is going to be a little bit of a bright spot as we go through the remainder of the fall season. The question is going to be, what happens when you have to turn indoors? Because propane heaters only work for so long until the winter comes at you. And will people feel comfortable going back indoors, and at what rate, and at what utilization of the actual restaurant itself? Now we want to talk with you about exports and what's happening with crude exports, product exports. And here, when you look at gasoline, again, we've been talking about how gasoline and distillate, we're going to see a little bit of an increase. Again, this is something that is actually going to be relatively sticky as we go through the remainder of, let's call it the next 2 to 3 weeks on average, just because we are seeing a little bit more pickup in terms of the export market, in terms of demand, because we do have some of those timing delays on bringing some of that Asian product over into specifically Europe and into Latin America. So we're going to see a little bit of an increase. Again, LPG was another bright spot. That's going to remain, and that's that propylene line, just because the demand remains relatively robust, specifically in India and other parts of Asia and Europe. So that's something that will be a nice bright spot. The issue here was we had a decline of about 1 million barrels a day in crude oil exports. Now, that's not something that is going to be sustainable, just because we do have an increase in demand into Europe. We have an increase in demand into Asia. So China has come out and said that they've purchased about 860,000 barrels a day. That, whether they come in and actually do that is an unknown, just because we see Urals at 4-month lows, specific West African grades, as well as Middle Eastern grades, trading at discounts. So the question is, will they really come in and purchase it? Again, it's going to be hard to tell, but they could try to flip it. But regardless, we're going to see an increase back to about 2.6, 2.7 million barrels. And it's really just timing delays. We keep talking about timing delays. You have to, there could be crowds at the Houston Ship Channel, other ship channels that will impact kind of how things move. If we have a lot of product, then, crude tankers will struggle to get in there. So it's all timing. But again, the exports for products will remain relatively strong, while crude oil exports will start to see some recovery. But again, still not see what I think we were believing or expecting prior to COVID. And it's just because even with the OPEC cuts, it's just not enough, because OPEC is starting to normalize, which is something that we're going to go into more detail on OPEC and refined products globally on Friday. So here, when we look at the gasoline exports, we on a seasonally adjusted level. Now, if you notice, it goes back to 2011. We can go back further, but in terms of the way people are consuming, we think this is a better adjustment of the bottom end of the curve. And here you can see that we set a new seasonal adjusted all-time high. And it's something where we're going to normalize a bit, but we're still going to continue to kind of set these seasonally adjusted records as we get some of this demand remaining relatively sticky into Latin America, like we talked about last week. Mexico seeing another increase in demand, and some other parts of Latin America. But again, it's going to be weighed in terms of when does that Asian product start to show up, which we know is in transit. And here is distillate. So distillate, again, set that new all-time high going back to 2011, seasonally adjusted. This is going to remain relatively sticky. It's going to pull back a little bit, but we need refiners need to try to clear out some of the storage as we go into shoulder season, because they have an option. They can either increase run cuts, but if you increase too far, then you can't actually operate the facility. So you have to clean out some of the storage. And this is going to be a good way to do it, is getting some of this refined product into market. And when we turn around and look at US, Japan, and Fujairah, you can see, again, we continue to trend in the right direction, but the pace remains very slow. And we're starting to see kind of this normalization. Fujairah had another decrease in distillate storage, and that is really start showing up a bit in terms of, as we talked about with California, a little bit of an increase in shipping. Japan saw a net increase when we look at oil and distillate, and then the US saw a net decrease. But again, the pace is starting to slow. And as you see, as we get into that September, October, we normally start to see those increases. So we're really not going to close that gap right before when we start to see those increases again, which is going to be a huge weight going forward. So thanks again for watching. We're going to come to you with another episode on the economy show. And then we're going to follow that up with a special Three Gorge Dam update, just now that we have a new flood that's surfacing. And then on Friday, we're going to have our favorite, the primary vision frac spread count. And then we're going to wrap up with an OPEC Plus update, which will probably launch on Saturday, just so you have something to watch and to remember us by throughout the weekend. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.